Okay, right now we will summarize the positions so far we have seen. There are four positions we have seen. Wonderful. Very simple, straightforward. Look at it. Part A says long call. Long call works like this. Until the price is below K, there is no profit maximization. In this case, we have not taken the account of the price, so therefore it's a payoff. It's not a profit diagram, it's a payoff diagram. So after when the ST breaches the K, then you see the graph going up. That means profit function is working. What about long put? Until the price is above K, ST is above K, you are not in the position to exercise. That's not the objective of you. Because until ST is above K, you're not making any money by exercising. The minute the price falls below K, you can still sell it at K and offset the price for whatever the ST is at that time. So the ST is a variable, I told you. ST can be anywhere. It can move from above K to below K, or in this case of long call, the ST can move from above K to below K. Okay. So part C, the segment C shows you what happens to the writer's position. You look at it, it's a mirror effect of the long call. This is a short call. For a short call, the writer don't make any loss until the ST is below K. The minute the ST goes above K, so he has to start worry about paying off the profits which the long call makes. Similarly, the short put works in the same way. The long put and the short put diagrams are just a mirror image of each other. So as long as the ST is above K for a short put writer, he don't lose anything. He makes the premium. The minute the price falls below K, then he has to worry about paying you. Understand that so far? Okay, now we look into the summary options for their profit diagrams where you take into account of their cost. See, long call. You saw the dotted blue line here. The dotted blue line shows the net function. The red line shows the gross function. So the net function is that taking into account of the premium paid. So that's why until the ST is below K, you have got a loss function as a long call. You will have a loss because if you don't exercise it, you will go into a loss because not only you will be buying it or buying something, if you exercise, you will be still buying it at K, where you can buy it at a market price below K. Why you want to do that kind of stupid thing? To go and buy at K, still insist to buy at K, because that is your contract. The option contract says the writer willing to sell you that underlying at K, that is a strike price. If the ST has gone below K, why you want to go and exercise it? So just leave it unexercisable or just lapse it, so you lose your premium. But the minute the ST is above K, haha, you are in the region for profit. So it will reach to a break-even point here. When the ST is above the break-even point, all the more you have to exercise it. You will be exercising the call. Similarly to the long put, you have bought the option for selling something in the future date and you are worried the price may fall below K. You have fixed it the floor price as K. So if the ST is below K, yeah, well, you can still sell it at K. Assuming you can buy back as a ST, that makes the difference. So the blue dotted line taking into account of the premium. Similarly here for short call, long call, against the short call, function is minus max ST minus K. So until the ST is below K, the writer makes his profit. That is from the premium. The minute the ST breaches K, he has to begin to lose. The minute it goes below the break-even point, that means he is literally going to pay you. The short put works as the opposite diagram of the long put. Similarly, as long as the ST is above K, the writer will make the premium. The minute the ST falls below K, he has to worry about paying you. This liability begins. Understand that? Okay, further terminologies in options. Beside what we saw at the beginning, an option is in the money. I told you in the money, out of money, at the money, these three regions. An option is in the money if the profit can be made upon immediate exercise. For a call, the ST must be above K, I told you. If the ST, the minute the final price is above K, you can exercise it, you can make money. For put option, the ST has to be below K. So these are the regions in the call option and put option which gives you in the money region, we call it. Therefore, options are exercised if they are in the money region. Okay, what do you mean by out of money? Out of money region is the opposite of that in the money region. This out of option is out of money region is if a loss will be made if you exercise it. Nobody will exercise it. That's a since there is no obligation, you don't have to exercise it. You just can leave it like that. For a call option, if the ST is below K, no one will exercise it. Remember, for a call option, if you're a long call, the ST is below K, don't exercise. For a long put, if the ST is above K, no point. Because you are if the ST is above K, you're going to sell something, you don't have to sell it at K. You can sell it in the market as ST, higher than the K. Options are not exercised if they are out of money region. These two regions are called out of money regions. An option is at the money when ST equals to K, I told you. When ST is equal to K, you are indifferent. If you exercise or if you don't exercise, you will still lose your premium. Okay, now we look into the directions. Options has got directions. Why do you go for a long call or why do you go for a short call? Why do you go for a long call or why do you go for a long put? Every naked option, we call it naked option because you are not combining with any other underlying asset. You are not making a portfolio out of two assets with an option. Therefore, we call it as naked option, just option alone. Every naked option position embodies a view on the direction. Why do you want to buy a long call? Because calls are for you to buy something in the future. Or short puts. Both are bullish positions. So you sell puts thinking that the price will go up so nobody will exercise. You buy long calls because you know the price will go up and you can still buy it at a strike. Both positions make money if the price goes up. Neither is a sensible strategy if one anticipates market is going down. And like now, because of coronavirus and all this, the market is down. Everything is down. Oil price has gone down. Property prices are falling. Share prices are falling. Share indexes are falling. So that's the time you are bearish. You are in the bearish direction right now. That means everything is falling. So you go for short calls, long puts. You buy puts because that's the time put prices will become very expensive. The premium for puts will be very, very expensive. Or you short calls, you sell calls, knowing that price will fall. Nobody is going to exercise the calls. You make the premium. Or you go for long puts because if the price falls, you make money. Both positions make money if the market go down. Neither is sensible strategy if one anticipates the market is going up. Of course, there are important differences in the nature of cash flows from these strategies. But for the beginners like you all, please understand the direction which you are looking for. Here we are talking about direction, whether you are bullish direction or you are bearish direction. Simply say that when you want to buy something, if you are bullish about that particular asset, then you go for long calls. When you're bearish about that particular something which you want to sell, then you go for long puts. Isn't it so? Okay, options and the implicit volatility views. Okay, just now we saw the direction. Now we are trying to explore the volatility. What do you mean by volatility? The changes in the price. How huge is the frequency of change? The option volatility relationship implies that every naked option position embodies a view on volatility. So higher the volatility, what happens? If the lower the volatility, what happens? So long option positions, calls or put are bearish in view, bullish in view on volatility. You are bullish and high volatility, then you go for long calls or puts. Such position increase the value when the volatility increases and decreases in value when the volatility decreases. So you're bullish about something and you know the jump is going to be huge. Then buy calls, and sell puts. Or when you buy call, can make money when the price jumps up. Or when you sell puts, well, nobody's going to exercise the put, so you make money after the premium. That's the idea here. Either way, you must make money. So short option positions, calls or puts are bearish on volatility. You know there's going to be a very large swing down. Such a position increases in value when the volatility decreases. So here, position increases in value when the volatility decreases, and vice versa. So here, you know, the price may fall somewhere lower than K, then you go to long puts and short calls. Okay, I'll show you in a diagram later. Okay, direction and volatility. Combining these observations, every naked options position can be seen to be unique combined with this view. Bullish on volatility. So bullish on direction means you go for a long call. Bearish on direction means you go for long put. Bullish on direction, bearish volatility, you go for short put. Bearish on direction, you go for short call. Okay, these are combinations. Okay, the specialness of option. These observations highlight a fundamental difference between option and spot and futures and forwards. Okay, spot market, futures market, forward market you have seen earlier. Now we have got this option market, which I told you it is to buy a right, not an obligation. We can expect we can exploit views on the direction with spot futures and forwards also. Bullish on direction. When you're in bullish on direction, you long spot, long futures, long forward. Why? Because you buy and hold and sell at a higher price. Bearish on direction, you short spot, short futures, short forward. This is very simple. I think you have understood all these in the earlier lectures already. However, there is no obvious way to exploit views on volatility using spot and futures. Spot and futures and forwards did not speak about how huge the jump of the price will be, how volatile it will be. But in options, we are taking into account the volatility because what is the probability the price swing will be high or low? Options even permit pure volatility play where there is no view on direction but there is a view on volatility. How? You will see later. We have got other positions which you will read. Next lecture, we will learn how to bet purely on volatility using options. The strategies. Next lecture is going to talk to you about the strategies. So that is where we're going to exploit how to purely make money out of volatility. Well, I told you at the beginning, options are similar to financial insurance. Options provide financial insurance. The holder of an option has the right but no obligation, not an obligation, to take part in the trade specified in the option. The right will be exercised only if the holder's interest to do so. That is, if his option is in the money region, then he will exercise. If it's out of money region, then he just leave it to expire. This means the holder can profit but cannot lose from the exercise decision. It's one-sided, right? Okay, we look into one example now. It's a great example. Look at this very carefully. Cisco stock currently trading at $24.75 per share. The S0 is $24.75 per share. An investor plans to sell because he's holding it now. He wants to sell it. Investor plans to sell Cisco stock in a month's time and is concerned that the price could fall by that period. So, how he can create a safety net for this? Buying a 1 month put option on the Cisco with a strike price K will provide an insurance against the price falling below K. Right now it's $24.75. For example, suppose the investor buys a 1 month put option on Cisco stock with a strike of $22.50. He doesn't want the price to fall below $22.50, which means that in a put option, your K is the floor price what you want to set. If the price falls below 22.50, the put option can be exercised and the stock can be sold for $22.50. Or just go and get the difference from the stock option writer. If the price increases beyond 22.50, the put can be allowed to lapse and the stock can be sold at a higher price in the market. The option writer is not going to look for you. There's no obligation at all. In general, puts provide potential sellers of the underlying with insurance against decline in underlying prices. Put option is to protect against declining in the underlying prices, especially when you're holding the asset and you want to sell it. Higher the strike or longer the maturity, greater the amount of insurance provided by the put. See, like just now, the current price is 24.75. You have set a strike at 22.50. What about if you set a strike at 24? Just 75 cents fall that you can exercise already. The higher the strike or longer the maturity, greater the amount of insurance provided by the put. And higher for higher strike, premium will be higher. For longer maturity, the premium will be lower. Okay, another example. Call option as insurance. Apple stock is currently trading at $218 per share. An investor is planning to buy the stock in a month's time and is concerned that the price could rise sharply over the period. So, what can you do? How can you insulate yourself? Buying a 1 month call on Apple with a strike of K protects the investor from an increase in the Apple's price above K. For example, suppose the investor buys a 1 month call at a strike of 225. See, right now it's 218, but you are buying a K slightly higher than that is 225. If the price of the Apple stocks go beyond 225, the call can be exercised and the stock purchased for 225. If the price fall below 225, very simple, go to the market and buy. The option can be allowed to lapse. The stock can be purchased at a lower price in the market. That's the idea here. In general, calls provide potential buyers of the underlying with a protection against increases in the underlying price, especially when you buy in the future. The lower the strike, the longer the maturity, greater amount of insurance provided by the call. Okay, summary of what we have learned today in this lecture. This lecture has looked or exploited at naked option positions and their implied views on market directions and market volatility. Both. While you have learned spot market, forwards, and futures did not speak much about volatility, here we are talking about volatility as well. There is a standard deviation function. Main observation is each naked option position is a unique combination of views on the market direction and market volatility. So long calls, you are bullish on direction and volatility, both. Long puts are bearish on direction but bullish on volatility. Short calls are bearish on direction and volatility. Short puts are bullish on direction, bearish on volatility. You will learn all these directions and volatility as we go in next few lectures. Key institutional features are shown. I'll talk to you in the next lecture about the market institutional functions. Not much, but actually how. Mainly, most of the options are sold in the OTC market, but of course, you have institutionalized also. The next lecture, we examine the range of option trading strategies using options. Each of these strategies exploit these implied views to set up a portfolio that reflects specific views on direction and volatility, and where how you're going to neutralize your losses. Okay, thank you very much. See you all again. Please join in for my Zoom this afternoon. I will send you all the ID. Okay, I think that's it. Thank you very much.